Hey, welcome in. Thanks for joining our channel. We're happy you stopped by to Everything Money. As always, I'm your handsome and debonair host, Seth. I'm here with Paul. Paul, how are you, my dear friend?
I am wonderful.
Today, we're talking about what is PE. It may be confusing, but there's a lot of new investors coming into the market this year. And Paul, as much as we talk about how new money can be dangerous, I'm happy to see that people are committed. People like yourself are committed to saving as opposed to spending your 20s, maybe 20s and 30s. And so with all you people, with all you new folks entering the market, I stand here asking Paul your questions. And the first one today we want to go over is what is PE ratio? This is one of our pillars of our 8-pillar analysis when we're looking at a company, the fundamentals of a company. And Paul's going to explain what PE is and why it is important. Stay tuned. Paul, go ahead and give us what you got, baby.
So PE is a very common, probably the most common value metric out there. When everybody talks about a company, they'll say, what's the PE of the stock? Now, very simply, PE ratio is price divided by earnings. Okay, now Uncle Seth, how do we get price? There's two ways to get price here, right?
This is market cap or price of the stock share?
That's a great question. You can do both.
Come on.
So what you do here is most people go to the price of stock divided by the earnings per share. Okay?
Yeah, yikes, Paul. I'm getting confused already. Now bring me home now.
Okay, so what we have here, how do we figure out the earnings per share? It's very simple. First off, you can go to our everythingmoney.com website, sign up. It'll tell you the earnings per share or any other finance site out there. Or you can sit there and do it by yourself. You would sit there and get the net income for the last 12 months. It's called trailing 12 months, TTM. That's taking the last 12 months of net income and dividing by the number of shares outstanding. Okay, so as an example, let's say a company has net income of $100, right? Mm-hmm. So at the end of the year, you look at the bottom of their most recent 4 quarters or trailing 12 months numbers, it shows profit of $100. Let's say they have 50 shares outstanding. So in the marketplace right now, there are 50 shares that people own. Whether it's mutual funds, individual investors, people in the company, etc., there are 50 shares. The earnings there per share is $2, correct? $100 divided by 50. Mm-hmm. So that is the earnings portion of this. Now, let's say, to get the PE of it, let's say the company is currently selling for $40 per share on the market. You go to the stock ticker symbol, you type it in, and it says, hey, the current price is $40. To get the PE, you take the $40, which is the price, and divide it by the earnings per share of $2, and you have a PE of 20. Very simple, right?
Yep.
That's how you can do it. Another way to do it is the market cap of the company is essentially the price of the company. Because if you remember here, if you take the price of the company multiplied by all of its shares, that equals the market cap. It's just the bigger way. Let's say hypothetically, you want to buy all the shares in the market of the company and you want to own the company completely yourself. You have to buy every single share outstanding. So you go find number of shares outstanding, multiply it by the share price, and that's your number. That is the market cap. So the other way to look at it is market cap, and you divide that by total earnings at the bottom of the net income statement for the last 12 months. So in our previous example, the net earnings were $100, right? Correct?
Yes.
Great. $100. And let's say the company was worth $2,000. What's that PE? 2,000 divided by 100 equals 20. Mm-hmm. Yeah, so that's going to give you a PE of 20, which is the exact same thing. Those numbers will all equate out. So the next question we have is because it's part of our 8 pillars, right, Seth?
Yeah, why is this important?
So it's important. It's a very short-term way of looking at a value because it's only 1 year's worth of information, right? You're only taking the last 1 year. In any given year, there's going to be ups and downs between any company, right? So but it is a good guideline of how you sit there and start looking at a company. Our 8 pillars, no individual pillar is the be-all and end-all. It's about looking at the whole picture, right? Mm-hmm. It's just historically, do you know the historical average, Seth, for PE?
PE, well, I mean, we love the number 20 around here.
We talk about 20, but that's not the historical average.
Go on.
The historical average for the market is about 15. Okay?
Even lower.
Yeah, we talk about 20 because I do acknowledge that a company that is between 15 to 20 but is growing a little bit should be worth a little bit more money than just the average of 15. We want to be able to factor in growth into the future prospects of earnings, right? If you had a company today that was making $1 per year, but you thought the future looked like this, versus another company that just made $1 per year, which one would you pay more for, Seth?
The top one, of course.
Of course you would, because you're going to make more money as the future goes on. So it's no different. I don't want to exclude companies that are selling for the lower than the historical average of PE when there could be a million reasons why that's the case. In fact, a lot of companies will make acquisitions and in future years realize those acquisitions are bad acquisitions and they write off the purchase. That's going to hurt your PE because it really drops down your earnings. And when you have earnings in the denominator and earnings drop, it makes the PE ratio go up inversely, right? So we don't want to sit there and exclude things just for one-time occurrences. That's also why I don't look at PE. Actually, PE is not really one of the more important pillars we have. It's just the most common one people talk about. So that's why we include it in the analysis.
I do think it's a good place to start. Obviously,
For sure.
you know, Paul, my 11-year-old is really into financials, looking at stocks. And so he can glance at the PE and get some semblance of where this company is being valued at.
Correct. And instead, you know, if you remember, a few months back, we did Walgreens. And I remember excluding Walgreens in my initial analysis because it had a 70 PE. And then one of our patrons came on and said, hey, can you do an analysis on Walgreens? So we did. And I realized Walgreens had a couple write-offs. They had some acquisition charges. And I was like, wait a second. This isn't 70 PE. And I bought the stock that day.
Come on.
For $38, and now it's at 55 because the PE was misleading. And that's an example of how sometimes our 500-foot view can exclude certain things.
Yep.
Okay, so we always want to keep PE in mind, but we don't want it to be the be-all and end-all because a low PE may not be a great thing either. As an example, if a company sells off a division, let's say a company has 3 divisions, and one division they sell it off. They have a one-time huge gain because they sold it off of $5 billion, and the rest of the other 2 companies make $2 billion a year, total $7 billion. That $5 billion is not a recurring income. You want to only really include recurring income in that PE. You want to exclude one-time charges either to the negative or one-time gains to the positive, right? So PE is an awesome metric to get a really quick, how's it done in the last year? And also, I love it for value investors because people focus so much on PE. And the example I just gave you about Walgreens is a good way that the astute investor who's going to do more analysis using our everythingmoney.com website will be able to sit there and say, wait a second here, there's more information here. People are ignoring the stock and they should not be.
Yeah, so Paul's going to pull up a couple companies here to look at, one with a low PE and one with an incredibly high PE to give you some examples of what maybe you should be looking at. Again, as I said, my son, we use PE. The number on our show we usually like is 20. So to pass one of our pillars of 8 of our fundamental analysis, you know, we like it under 20. And a lot of times we'll get some of these bangers, some of these crazy hot stocks with really high PEs. And Paul's going to show us a couple right now. So what's a good company, Paul, that you like here?
So a very popular company, I'm not going to go about good, is Tesla. Our good friends at Tesla right here, right? So Tesla's currently selling for $744 a share, right?
Sounds great.
Right, it does sound great. Now let's do the analysis we did before for PE. Let's do it the long way. We're going to do market cap divided by earnings, okay? Now, here's the great news, Seth. Our wonderful Everything Money software has it for you on the very first page. Market cap, $707 billion. $707 billion, and earnings over the last 12 months, $690 million. Okay, so let's call it 0.69 billion. Seth, can you do me a favor? Can you divide that number out real quick?
707 divided by 0.69 is 1,024, Paul. 1,024.
We have it listed at 1,030. Probably some rounding thing going on. 1,024 versus a historical average of 15. Okay, now, does this in and of itself mean Tesla is overpriced? No. Do I think Tesla's overpriced? Absolutely, but for other reasons. But initially, you're going to sit there and see that Tesla is currently selling for 70 times more than the historical average for companies in general, okay? This is a very high PE, But remember, years ago, I was wrong about Amazon. Amazon was selling for higher, it actually was about 1,000 at one point and ended up growing into its value. So Tesla, part of your analysis would be, how can earnings jump up to justify this market cap? And that's all part of it. But this is one of the highest PEs out there. I mean, I should say this, apart from a company that has some major drop in earnings, this is the highest PE I know of a stabilized company that's still, doesn't have any one-time write-offs or anything like that, okay? Now, a very popular company amongst our Patreons is MSG Networks. Now, again, let's do the math here, Seth. Market cap, call it 900 million. And trailing 12 months of profit, 180 million. Very easy math, 5 PE.
Yep.
And that's what you get right here, 5 PE. This is a very low PE. Now, whenever I see a low PE, I don't go, let's do it. I go, hang on a second. Let's figure out why this PE is so low. I want to make sure it's not some one time, we sold the division off, it gave us a big check, etc. I want to make sure that it's a reasonable reason why the PE is low, and then had to figure out, okay, but even then, why is the PE so low? Even if it's consistently earnings going up, there's going to be some other reason, because the vast majority of stocks that are selling low have a reason they're selling low. But the PE is a great, great way to look at it from a snapshot point of view and say, how did the last year go?
That's our take home on PE. It is one of our pillars of our 8-pillar analysis. If you're one of our fans and have seen this before, we have our numbers that we love, and we hope you are learning them. And if you're new to this, we're going to do more videos on our 8-pillar analysis, all the 8 pillars and what they mean and how they all work together to valuing a company. And hopefully, if you're buying or selling shares of this company or getting into it, you know what you're doing. Paul, that's it. PE, thanks for joining us. As always, make sure you tickle the like. Check out the Patreon below if you love what you're seeing. And thanks, guys. Appreciate it. Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.